Hello, everyone. Thank you for joining us for today's Financial Issues Forum featuring Sebastian Malaby speaking on his book, The Power Law: Venture Capital and the Making of the New Future. My name is Srish Chatterjee, Professor of Finance at the Gabelli School of Business and Gabelli Chair of Global Securities Analysis at Fordham University. On behalf of the Gabelli School, a very warm welcome to all of you. In the last several years, the Gabelli Center and our wonderful co-presenters, the Museum of American Finance and the CFA Society of New York, have sponsored many webinars and events that have drawn a large number of friends and professionals. We are grateful to all of you for your continued support. We are also tremendously proud of the dynamic collaboration with the museum and the CFA, and a full archive of our video content will be shared in the thank you note which you will receive. In just a moment, David Cowan, President and CEO of the Museum of American Finance, will give a full introduction to Sebastian Malaby. After Mr. Malaby finishes his talk, he will address questions submitted through the question field that is located below the video player. Please feel free to submit questions at any point during our event. We will be addressing as many of them as possible during the Q&A session. All attendees of today's event will be receiving digital copies of Mr. Malaby's book with information coming to you following our event. And now I'm delighted to turn it over to my good friend David Cowan, President of the Museum of American Finance.
Thanks, Suresh. Good as always to be back with you and all of our friends at the CFA Society. Sebastian is the Paul A. Volcker Senior Fellow for International Economics at the Council on Foreign Relations. He contributes to a wide variety of publications, including Foreign Affairs, The Atlantic, the Washington Post, and the Financial Times, where for 2 years he was a contributing editor. But of course, our most favorite publication is none other than our own Financial History magazine. And in there, he had a short piece about his book, More Money Than God, which was about hedge funds. And that book was a New York Times bestseller and the winner of the prestigious Loeb Award for a business book. His book about Alan Greenspan was also noteworthy and recognized with awards, including the George Eccles Prize in Economic Writing. In the Power Law, Sebastian explains how innovation happens. Interestingly, often it is not from so-called industry experts, but more imperatively, it is about how is innovation funded. The core of the book is rich with stories about the winners and the losers. Hindsight is easy, but one story that jumped out was how many VCs passed on Apple, including one in particular who was offered 1/3 of Apple for $50,000. He said, I was, quote unquote, so smart I passed. It's kind of fun to think about when I'm not crying. One fact that astounded me is that there are currently globally about 1,000 unicorns. These are startups worth more than $1 billion each, and many are in no rush to go public. Today, we will learn that venture capital is not just a business, but to quote our author, it's a mindset, a philosophy, a theory of progress. So with that in mind, let's progress onto our talk. It's my pleasure to introduce Sebastian Malaby.
Great. Well, thank you so much, David, and thank you to all of you attending on this call. I thought I'd start out this talk about venture capital by telling you a story which happened after the publication of my book. So it's not a story from the book, just in case any of you have actually already read it. Rather, it's a story that happened after it was published, and I got contacted by lots of people all over the world. And in particular, this story relates to somebody in Bangalore, India, who got in touch, and he said he loved the book. He was somebody who had been an engineer at Intel in the United States and been to MIT Business School. And then he'd returned to India and he'd begun making investments on behalf of Accel Capital, which is one of the venture partnerships that I write a lot about in the Power Law. And he explained to me that he got back in 2010. And I said, I'm always interested in financial history, so tell me how things have changed. 2010, now we're talking in 2022, this was a few months ago. How have things changed in Bangalore in terms of the entrepreneurship scene and all that? So he said, well, I'll tell you a story. I began investing in 2010 when I got back, and I made some investments in different startups. And after a bit, one of the startup founders came to me and said, I need your help. And, as a venture capitalist, your job is to help the startup founders, to be there as an advisor. So the VC says, sure, you want my help? I'm here to help. What do you want? And the founder of the company says, well, I want to get married. And the venture capitalist says, yeah, okay, I'm in the service business, but I didn't realize that fixing up your marriage was going to be part of the service here. But anyway, why are you coming to me about this? And the entrepreneur says, well, see, I want to marry my girlfriend, but her dad thinks that an entrepreneur is by definition a loser. Startups are always failing, and therefore he doesn't want to let me get married to his daughter. And, I need his permission. And you, Mr. Venture Capitalist, because you've lived in the United States, you've been an engineer at Intel and all that, you have the kind of standing that allows you to telephone my prospective father-in-law and explain to him that entrepreneur is not a loser. And so, the VC thinks about this. He's a bit surprised about this request, but he wants to be helpful. So he calls up the girlfriend's dad and says, entrepreneur is not necessarily a loser. Some entrepreneurs do really well. Their companies sell for, hundreds of millions of dollars. Maybe your daughter, if she's in love with this guy, she should be allowed to actually marry him. And, the father-in-law sort of thinks about it and he relents and the marriage is allowed to go ahead. So I'm like, okay, that's a good story. That's 2010. Tell me how the scene is in 2022. Are you still having to make telephone calls to, various fathers who want to obstruct the marriages to entrepreneurs? And I'm told, no, that not necessary anymore, because all of the prospective father-in-laws are watching the TV show about venture capital, Shark Tank, and they are watching it in Hindi. And I start with this story, partly just because it's a fun story, but also because there's a serious point to it. The serious point is that you can have a culture in India which was sort of anti-entrepreneurial in 2010, very skeptical about the value of startups. But by 2022, it had flipped around and, the status of the startup and of the startup founder had gone up immeasurably. And when I related this story to one Indian American friend of mine, she said, yeah, and what's more, you can actually track that rise in entrepreneur status by looking at the wedding sections of Indian newspapers, where they give you the dowry price being offered, which varies according to the status of the bridegroom. And sure enough, entrepreneurs are attracting higher and higher valuation in the marriage market, apparently. So there are data to support the anecdote. The point here is that, culture can change. And that's something which I find people don't always believe. When I give versions of this talk to audiences in Europe, I'm speaking to you now from London. I've been contacted by tons of people in, France and Germany and so forth. I often get told, well, you've written a great book, Sebastian, about Silicon Valley, about venture capital in Silicon Valley. But, that's a cute story about Silicon Valley, but it's never going to happen the same way in Europe, because in Silicon Valley, when a company fails, the entrepreneur thinks it's a learning experience. But here in London or Paris or Berlin, we think a failure is a failure. We don't see the upside in failure. And so whatever it is they are drinking in the water out in Silicon Valley, We don't have the same stuff in our water, and we just don't have that risk appetite. And therefore, you're not going to have an entrepreneurship culture in quite the same way. And I say to them, no, that's wrong. If Bangalore in India could switch around in a dozen years, then Europe can change as well. And what you have to remember is, right back at the beginning of the story that I write about in my book, even Silicon Valley was not entrepreneurial. In the 1950s, the classic book about American business was called Organization Man. And it was about the white collar, hierarchical work culture of the 1950s, where the assumption was that, you joined a large corporation when you got out of high school or got out of college, and you stayed there until your 60th birthday, whereupon you would retire. And if you were lucky, you might get a gold watch. And that was kind of it. You worked your way up the hierarchy. It was the era of, big business, big labor, big government. That was the 1950s. And there's a chapter in that book, The Organization Man, called The Bureaucratization of the Scientist. So this was not restricted to just, kind of pure business jobs. Scientific research, R&D was also very organization, big hierarchy focused. And that was the culture in the 1950s in Silicon Valley as well, which of course back then was the Santa Clara Valley. It wasn't called Silicon Valley. And somehow it changed, right? So in the 1950s, as I say, no entrepreneurship culture. But as we all know, by the 1970s and 1980s, you've got startups like Apple in personal computers. You've got Intel started in the late 60s. You've got Genentech. Later, you've got Cisco. You've got Netscape in the 1990s. eBay, Google, you name it, Amazon. All of these amazing companies coming out of Silicon Valley. And I tell all these origin stories in my book. And so what had been the organization man culture transformed itself into the venture culture, the entrepreneurship culture. Just like there was that shift I began with in Bangalore, India, and just like I think there is going to be a shift, which is actually already beginning in Europe, and it's kind of spreading around the world. And that's why I'm pretty optimistic about the future of innovation worldwide. But the question is, how does this shift in culture come about? And the answer I come up with through my research, I spent 5 years, interviewing venture capitalists and entrepreneurs for my book. And at the end of all that work, what I concluded was that the sort of underappreciated secret sauce that really drives this shift from, being fearful of entrepreneurship to embracing it, it's driven by the risk capital, by the venture capital, by the venture capital which comes and underwrites a risky venture. So right at the beginning of my story, I tell the story of, right at the beginning of my book, I tell the story of Fairchild Semiconductor, which is kind of the grandfather of a lot of later electronics firms that began in Silicon Valley. And the story is that, there was this company called Shockley Semiconductor, started by a brilliant Nobel Prize winner who had been instrumental in the invention of the transistor. And he, was a terrific scientist, but a terrible boss. He would belittle people and make fun of them and say stuff like, "Are you sure you have a PhD?" And, "You must be an idiot because you agreed to work for me for such a low salary, but tough on you. Now you've signed the contract and you can't change it." So he would just sort of sneer at people and make them feel terrible. And a group of his brilliant scientists that he'd recruited wanted to quit and get hired by another company. They wanted to stay together as a team because they figured they would invent more if they stayed together as a group. But they didn't want to work for this guy, Shockley, who was a total tyrant. So anyway, they're looking around for somebody else to hire them. And it doesn't even occur to them that they could go off and start their own company, because the notion of a startup back in the 1950s, again, just was not kind of part of people's language. So they're looking for a company that could hire them, and they write a letter to a stockbroker in New York that they've heard about, saying, "Would you know of any other electronics companies that might be interested in hiring a ready-made team of engineers. The stockbroker, who was called Arthur Rock, and had already funded another semiconductor transistor maker company, thought to himself, well, maybe this could be a new startup. I mean, it wasn't a normal thing, but he had this sort of weird and very atypical conviction that you could try and do it. So he flew out to the West Coast to meet with these engineers, and he said, look, rather than joining another company, you should create your own company, and then you will get some upside. If it succeeds, you will own some of the company, you'll own equity, and you have a shot at getting rich. And the engineers are like, oh, what are you talking about? We don't have any capital to start our own company. We can't do that. And Arthur Rock, the financier, says, you don't have any capital, but that's my job. I'll raise the capital for you. And they're like, yeah, right, whatever. I'm sure you couldn't raise very much. And he says, I will raise for you at least $1 million. That was a huge number in the 1950s. And he was trying to shock and awe them into like paying attention. And it succeeded. That really did get their attention. And so they're like, ooh, you think you can raise that much? And he says, yeah, all you need to do is, pick who is the leader among you, who's going to lead the company. And, then based on your credentials as terrific engineers, I will find somebody who wants to back you. And so he was as good as his word. He found somebody who would back them. They quit the Shockley company, and they set up their own company, Fairchild. And they are known to this day as the Traitorous Eight. Think about that. Traitor. The word traitor is telling us that it was super unusual back then to start your own company. So again, the point is, this was just not a normal thing to do. But once they had done it once, and once Arthur Rock had demonstrated that you could liberate talent from a big company and set up a new small company, and indeed give those engineers a piece of the action if they succeeded, a lot of other engineers said, hey, I kind of like that idea. Maybe I could do that too. And the first place it began to happen is actually within Fairchild. Other engineers within Fairchild started to split off and start their own companies. And sometimes Arthur Rock would be the one to encourage them and would finance them in their new venture. And then eventually, the Fairchild backer, which was another company on the East Coast, became another kind of Shockley, another onerous boss that initially had treated the engineers well, but then it had an option embedded in the original contract to buy out all of the equity. And once it did that, it was no longer so attractive because it wasn't a proper startup anymore. It had been basically acquired by this East Coast parent company. So now even the founders of Fairchild, the 8 traitors, wanted to set up their own companies. And eventually they said they wanted to do that. And Arthur Rock said, what took you so long? I'll liberate you again from the company that you guys started yourselves. And so that's when they spun out and they started this time Intel, which of course remains an important semiconductor company to this day. And so, that is the story of how Silicon Valley really got started, through a financier who said, you can set up your own company. I know it's an untypical thing to do, but it's possible to do. And to this day, what you have all around the world where you have clusters of venture capital is that you have engineers who are working for some other big company who have a product idea. For whatever reason, the boss at the big company doesn't want to do it. And the engineer says, screw it. It's a good idea. I'm going to leave this big company and set up my own company, but I can only do that with some help. And if there is a venture capitalist, the venture capitalist will say, sure, I can raise the capital for you. Oh, you don't know how to incorporate the company? Well, I know some good lawyers who specialize in startups and they can incorporate it for you. Aha, you have a problem. You want to hire 4 other engineers to help you build a prototype. I know that sounds daunting, but I have a Rolodex with like 24 engineers and I can introduce you to them and you could pick the 4 that you like. And then maybe the startup founder says, yeah, but I'm a bit worried about this because why would these great engineers come and join a little startup like mine when they work at a big, safe company? And it's risky to join a startup. And at this point, the venture capitalist says, don't worry, if you join the startup, sure, it is risky, but if the startup fails, but you've been a good contributor as one of the early engineers, I will find you another job at another startup because I'm funding new startups all the time. And so I will slot you into a different position. And in that way, the venture capitalist de-risks the act of joining a startup. I always remember a story told to me by Eric Schmidt, who was, of course, the chief executive of Google towards the beginning of Google's existence. And Eric Schmidt explained to me that he would never have joined Google if it had not been for the influence of the venture capitalist who had backed Google, John Doerr of Kleiner Perkins. And John Doerr said, look, Eric, this is going to be a great startup. And Eric went to see Larry Page and Sergey Brin, the two founders, and came out saying, I'm not going to work for these guys. They're arrogant as heck. And they believe that anybody aged 30 or more is by definition stupid. And so why would I work for these young punks who might just turn around and fire me just because I'm aged over 30? So he said to John Doerr, forget it, I'm not doing this. And John Doerr is like, no, you should do this. And if the young punks bounce you out of a job, don't worry about it, because I've got other software companies. And Eric, I will make you the chief executive of one of the other ones. Trust me. So that is the basis on which Eric Schmidt agreed to join Google. He wouldn't have done it otherwise. And if he hadn't have done it otherwise, who knows? Maybe Google would never have become a company that then became a household name, because at the beginning, Google had a great search technology, but it had zero business model. It had no concept of how to make money. It had no ad business envisaged yet. And that was all brought to the party by Eric Schmidt and the team that he built around him. So really, that ability for a venture capitalist to persuade the early talent to take the risk of signing up to a startup is key to the survival and the success of startups. So I think the way you get that transition that I began with in Bangalore, from a culture where people think that startups are just super risky and you shouldn't touch them with a barge pole, and neither should you allow your daughter to get married to somebody or your son to get married to somebody who is a startup founder, it's just too risky. You change the culture from that position to one in which people are okay with it by having demonstrated successes where you get a unicorn, a startup that becomes worth more than $1 billion. And then people get excited and they think, wow, this could be exciting to do startups. You get the model of success with venture capital that backs the startup, that makes it easier for the startup to hire the first engineers, to hire the outside chief executive, to connect with the early first customers, to create that kind of network that, takes a great technology and connects it to all the opportunities that it needs to become a great business. People sometimes say in life, so-and-so succeeded. And that's partly because so-and-so was smart and so-and-so worked hard. But often, that person also had a couple of unfair advantages when they started out in life. They started out with money and connections. Well, you can think of a venture capitalist as somebody who arrives and meets an entrepreneur and brings money and connections. In other words, the capital to start the company, and then the connections you need to hire the good people at the beginning when you have no brand, to persuade an early customer to take a risk on buying your product. So those connections are as important as the capital. And in this way, by de-risking a bit entrepreneurship, which will always be a very tough path, don't get me wrong, but it will be a bit less tough with a venture capitalist who brings the money and brings the connections. In this way, you can have a financial specialty venture capital that sort of, changes the culture, that de-risks the act of entrepreneurship, that liberates talent from big companies. And in this way, venture capital is actually something that manufactures courage. So that's the first thought I wanted just to get across to you, this idea that you can really change the culture and create courage. But I want to talk a little bit before I wrap up about other things I was trying to do with my book. I had really two goals when I started out. One was just to solve the intellectual mystery of how a venture capitalist even thinks about investing. How do you allocate capital to a very early stage startup? That's the sort of intellectual puzzle I wanted to unravel. And then secondly, talk about the effect on the world of this financial specialty. So there's like, how do you do it, and then what's the impact? Now, on the how do you do it, on the intellectual mystery of how you allocate capital, the reason I think it's a fascinating puzzle is that other kinds of investing. I mean, I wrote a book about public markets in the form of this book about hedge funds that David referred to at the beginning. More Money Than God was the title. And when you have hedge fund investors, like any public market investors, they have all these quantitative guidelines to help make decisions about investment. So at a very, very basic, simple level, they might look at the price earnings ratio of a stock. Well, in venture capital, guess what? There's no price earnings ratio because there's no earnings, right? An early stage company hasn't sold a product yet, so it has zero earnings. So you can't use a PE ratio. A public markets investor might think of the price to book ratio. But again, the book value of a early stage company is zero because it has no plant and no equipment and probably no patents even. And so there isn't a book value. So there's no price to book ratio either. And so all you've got is, two-legged mammals who walk into your office with a dream and say, we want to do a startup. Will you give us some money and invest in our company? And, how you even do that is the mystery. So let me just try to explain a bit about how I think that mystery works. When I first went out to Silicon Valley and asked people this question, how do you allocate capital to a startup? I would get a bunch of sort of funny stories, which were, delightful to listen to, but pretty much devoid of explanatory usefulness. So, I went to see Jerry Yang, the founder of Yahoo, and said, how did it come to be that you got an early investment from Sequoia? And he said, well, the investor from Sequoia, Michael Moritz, he had soul. I'm like, what does that mean, soul? Is this really the way that capital gets allocated? Some startup founder looks at, the investor and hangs out a bit and then says, this guy has soul. I mean, I can see that might be good for, music or something, but this is business, this is investment. Surely it's not just soul. Then I went to see the founder of Stripe, the payments company. And I was told, well, this is the founder, Patrick Collison, who said, I had this, road bike and it was a Cervelo. And I'm like, yeah, okay, so you had a Cervelo road bike, so what? Well, the investor who backed me, he kind of liked my bike a lot and was also a cyclist. And he asked me what my time was on a certain climb people do in Silicon Valley on the weekends. There's a sort of famous Old La Honda climb, it's called. And I had a time, whatever it was, 23 minutes and 42 seconds. And the investor's like, whoa, that's pretty fast. And then we start talking about it. And then we clicked, and then he invested. I'm like, well, again, that's a nice story, but is that really how capital gets allocated? And then there was another story about the origins of Dropbox. And there, the origin story has to do with the fact that one of the founders, Arash Ferdowsi, was originally from Iran, and there was an investor who happened also to be originally from Iran, and they spoke Farsi together and they bonded, and then the investment happened. And again, I'm sure there's something to the idea of human connection, but is that really how people make proper investment bets? It seemed like that wasn't quite the full story. And it was only kind of on the third or fourth trip to Silicon Valley and maybe the 30th or the 40th interview that I started to really feel like I was kind of getting under the hood and understanding a bit how you think about allocating capital when there's zero in the way of financial signposts. And it starts really with this idea of the power law, which became the title of my book. And that is this idea that, some startup investments are going to take off exponentially in value. They're going to grow not in a linear way where, every month you add $1 million to your amount of sales. It's going to, be exponential. It's going to go from 1 million to 2 million to 4 million to 16 million. It's just going to take off in a curve that goes up like an exponential curve. And that's going to be so profitable and so wildly exciting, by the way, that it will make up for the fact that most of the time when you back startups, they go bust and your return is going to be zero. And this is fundamentally different to the return profile you might get if you invested in bonds or stocks or hedge fund type of strategies, where it's extremely unusual to make a public equity investment where you buy some stuff in the stock market and it goes to zero. I mean, it happens now and again, you get a bankruptcy, but it's pretty unusual. Whereas in venture capital, it's not only usual, it's the norm. Like if you make 10 bets, probably 7 of those startups are going to go bust and you'll get nothing back at all. So that is a really negative part of the return profile in venture capital. But on the other hand, you're going to have investments that make more than 10 times your money back. That's 10x or 1,000%. And sometimes you might get 100x or 10,000%. I mean, think about that. No public market investment is likely to make, 1,000, 5,000, 10,000%. And that's extremely rare. And so you get this much more, skewed profile where, 1 or 2 amazing bets will generate all of the profits in your entire venture fund. And so it follows from that when you make a venture bet, the first thing you ask yourself is, does this dream that the startup founder sitting in front of me, does this dream have the potential, if it worked out, to be a huge return? Like if everything went right, could it be better than a 10x? Because if it's, if in a great scenario, it's only like triple my money, then it's just not worth the risk because I'm going to have these losses where things go to zero. I need for the successes to be 10x or more. So then by definition, if somebody comes to you and says, I want to open a restaurant, the answer is no. I don't have the right kind of capital to match your business because a restaurant is never going to make 10x. There's too much competition in restaurant businesses. So for it to be a potential 10x, there has to be, first of all, a newish technology, not newish, new, where it's going to be, at least at the beginning, so new that you have no competition. And therefore, you can charge a big margin on the product. And secondly, the total addressable market, the TAM, has to be big enough that not only can you charge a big margin on each unit sale, but you actually have enough sales to generate a ton of revenue and make that 10x plus return. And so the first questions that a good venture investor asks are these offensive questions. They're not defensive. How do I mitigate the downside? How do I avoid a loss? Because you're going to have a lot of losses in the business. And if you think about that, you'll never do any investments because each single investment you make has got a better than even chance of being a zero. What you have to think about is the upside. So that's the first insight that you need. Second insight is that you only ever use equity, right? So in the beginning of the venture story, there was a government program, the Small Business Investment Program, which involved debt for startups. That's a crazy idea because, a startup is supposed to be using all the capital it has to grow the business so that it can be a 10x. It's not supposed to be taking any money and paying it back to the financier. So debt, which you have to service, makes no sense. Another idea at the beginning of, sort of a threshold point about how venture works and how you make these bets is that, the investor has to go on the board of the company because you can't sell the position. It's not like a public investment where you can sell the stock if you don't like what the manager is doing. In this case, if the manager is doing something you don't like, all you can do is be on the board and try to persuade the manager, the founder, to take a different decision and go in a different direction. So it's a hands-on style of investing. And the next thing is you don't invest all the money that the founder is going to need to build a company in one go. You invest stage by stage in tranches. So what you say is, you have a potentially good idea. I'm going to give you enough money to have a runway for 6 months or 9 months. And then I want you to reach this milestone. And then if you reach it, we'll talk about raising you some more capital for the next 6 or 9 months. But in the first 6 or 9 months, I want to see you address the riskiest things that you see on the horizon. I want you to, if you're going to fail, I want you to fail early. I want you to fail quickly, because if you fail quickly, it'll burn up less capital, waste less capital. So that's good for me. But also, if you fail quickly, it'll burn up less of your time as a founder, and that'll be good for you. So think about what are the existential risks that might doom your project and tackle those first. Tom Perkins, the founder of Kleiner Perkins, called those the white hot risks. And he was a pioneer in this technique of stage by stage financing. Then if you go a little bit further along the history of venture capital, you get into the 1980s, all of these basic ideas of, power law mentality, equity only, hands-on, stage by stage investing. All of those ideas are well understood by the late 70s. But in the 80s, some new ideas come along. One is the idea of the prepared mind, where the investor sort of does an exercise at the start of the year and thinks thinks ahead and says, given where new technologies are developing, like today it might be, given where large language models and artificial intelligence are going, what types of business do I expect are going to be founded in the next 12 months? And what do those businesses need in order to succeed? What are the market niches which are going to be profitable? What type of person is most likely to found that kind of company successfully? Is it going to be somebody who studied a particular thing as a graduate student? Is it going to be somebody who came out of a particular company like Google or OpenAI or Microsoft? What are the incubators of this kind of talent? So what type of founder should I be looking for to support? And so by preparing your mind, when somebody comes to pitch you an investment idea, you can decide very quickly whether it's promising or not promising, because you've already thought through in advance what kinds of startups are going to work. Another sort of technique that venture investors developed is the incorporation of decision science, behavioral science, into their methodology. So one simple idea is that we know from behavioral science that people have loss aversion, which means that they naturally don't want to, kind of risk money to get the maximum upside. They're willing to, they have loss aversion, so they'll risk money paradoxically to avoid a loss, but they won't risk when they reach for the upside. And in venture capital, where it's all about trying to get that upside, as I explained earlier, that's a big problem. So one technique that Sequoia Capital, one of the great venture partnerships, which I write a lot about in my book, one technique they came up with was forcing investors to write down in a memo what they call the pre-parade section of the memo. In other words, imagine everything went right and you had a ticker tape parade for the successful startup that you backed. How amazing could it be? And write that down, because we're all human beings. We don't like to be embarrassed. We don't want to say out loud what our dream is of how well something could go, because most of the time it doesn't go quite that well, and then we look dumb afterwards and we're embarrassed. But if you require the investing partner to write it down in a memo, then you force people to get over that inhibition about dreaming how great it could be. Another idea is the deliberate reinforcement of your network in the cluster of kind of engineers and entrepreneurs. And that's another idea which has been incorporated into the best venture partnerships. And then the retention of operating partners. So a venture capital partnership might have people on the staff who are specifically expert at how to approach a problem like hiring real estate or recruiting great marketing executives or writing the first press release when you have an announcement to make. or how to prepare for your roadshow when you do an IPO. There are all those sort of in-house skills that a venture partnership might have that help the investor, that help the portfolio companies get off the ground. So those are some of the things which, as I told all the case studies of the great Silicon Valley companies that got started, those are some of the things that rose to the surface as skills in venture capital that help to unravel the mystery of how you allocate capital in this world which doesn't have quantitative benchmarks for success. And I realize that I'm in danger of giving you a sort of Fidel Castro version of this speech and go on forever. So I'm going to stop talking there in case you have questions. But anyway, thank you to everybody for listening. And I look forward to a bit of a discussion now.
Thank you, Sebastian, for sharing those fantastic insights with us and our audience. Questions are coming in. David and I may have our own questions to add. Let me start with the first one from William Green. The question is there much venture capital interest or involvement in the real estate LLCs for qualified investors that seem to be springing up in public advertisements?
Real estate is a whole different world. My study was really about technology investing. And so I'm afraid I would love to help you, but I just don't know much about the real estate world.
In your remarks, you mentioned about maybe talking about the effect on the world, but you didn't get to it because is there any way you could just give us a little snippet or two on that?
Sure. I mean, I think the big idea there is that the economy is moving more and more towards intangible capital. So what some people call, capitalism without capital. And in other words, instead of a corporate balance sheet having as its main assets, plant and equipment and fleets of trucks and so forth, it's really, brands and copyrights and patents and sort of, customer relationships and other intangibles that make up the value of the enterprise. And I think in that kind of world, the question becomes, how do you start that kind of company, a sort of intellectual property-based company? And I think what experience shows us is that venture capital is just the best way of doing that. Because it is intangible and it is hard to value, you only really know, let's say you've got a software that's been developed. A new software might be worth, billions of dollars if it's a really fantastic software, or it might be worth zero if it's not very good. And you can only tell the difference if you are pretty far into the detail of the company. And that's what venture capitalists do. They specialize in something like enterprise software. They really meet the entrepreneur and discuss the software before they do the investment. Then they go on the board and they watch like a hawk as the software is being tweaked and perfected. And they're really down there in the in the weeds with the builder of the software, and that's what you need in order to evaluate whether or not it's good. And so I think in this world of intangibles, investors who understand intangibles are going to be more important. And at the early stage of the company's journey, venture is going to be super important for that.
I think you touched upon this in your talk and probably just made a comment that addresses this particular question. This is the second question. This is coming from Ross Mendelkorn, asking, do many venture capitalists have talent packages along with the invested money?
Can you explain what do you mean by talent package?
That's what I'm reading in the question.
Yeah. I talk generally about talent and venture capital. I mean, one thing that venture capitalists do is that they help to recruit talent to startups that they back. And some people would even say that is the central thing that venture capitalists do. So right back at the beginning of the story, one of the things that was amazing about West Coast venture capital that made all the difference to turning Silicon Valley into the leading innovation hub in the world was precisely that you could have a product engineer with a great idea for a product, but no business partner who would actually sell the product and build a business around the product, right? And you kind of need both. You need, the engineer with an idea and invention, but then you need somebody who's going to turn that into a business. And the early venture capitalists in Boston would say, well, go away until you've got a business guy who is your partner. And the contrast with the West Coast was that on the West Coast, they said, oh, you need a business person who's going to be your partner. Well, we'll go find one for you. We have a network. And then they would work their network and they would recruit somebody who was running, let's say, a division within a big company to quit the big company and come to the startup. And the way they recruited the talent, and this is another super important thing about venture capital, is that they would provide stock options. And so this idea that everybody in the startup world should be incentivized with equity is very central. The founders of the company retain equity. The investors in the company buy equity. They don't use debt. And the people who join the company early on are compensated partly with equity options. And that is how you recruit great people. In China, I also write about China a bit and the growth of the ecosystem there. Alibaba would not have succeeded if it hadn't been able to recruit amazing world-class talent, including some Americans who were recruited to Alibaba early on. And the only way they would have joined Alibaba was because of the stock options that were being offered. So the key to the talent piece is this use of equity options, and venture capitalists are very much instrumental in structuring those options packages and then using their Rolodexes to bring in the talent.
Sebastian, we've got usually a lot of Gabelli students tuned in who would love to become a venture capitalist. So one part of the question is, what is a good way after they graduate to get involved in this industry? And secondly, a lot of students do care about diversity, equity, inclusion, and in particular going green. And I'm wondering, have you seen a change in venture capital towards those issues over the last decade, or is it the same as it ever was?
So it is changing. I mean, I call them out in my book because the diversity and equity and inclusion metrics are pretty negative. Specifically, when I looked at this, maybe a year or so ago, there were, of all the venture partners in Silicon Valley, only 16% were women, which is way below any reasonable benchmark. If let alone the fact that half the population or half the workforce is female. If you look at investment banking or other kind of comparable professions, it's way above 16%. 16% is absurdly low. And then if you look at the inclusion of African Americans, the number is 3% African American venture partners. And again, that is not only way below the workforce share, but also way below the comparable professions. So that's bad. It's getting a little bit less bad over the years, and I'm hopeful that there was a bit of a wake-up call in 2019, combination of the Me Too movement and the Black Lives Matter movement. And I think we've seen some shift since then. Of course, it could be faster, but I'm hopeful that it's moving in the right direction. You mentioned, climate change and green investing. That is something where the change has been really quite rapid. Clean tech is seen as a business opportunity for venture. There was one wave of clean tech back in around 2007, 2008, which failed. And it failed because it was premised on the idea that the 2008 election would deliver a new president who would do some sort of pricing or capping of carbon emissions. Both John McCain and Barack Obama, the two main party nominees, were saying that that's what they would do. And so a lot of venture bets were made on the premise that this was coming down the pike. But then what happened was that the 2008 crisis happened, everybody got distracted, bailing out the economy turned out to be more important than, or more urgent, maybe not more important, than doing something about climate. And so nothing happened on pricing carbon. And as a result, all those investments that were premised on a price for carbon went wrong. But in the newer wave of carbon-related investing, you've had a ton of new kind of battery technologies, which have yielded successful investments. A ton of sort of software that manages power utilization on the grid for optimizing when you draw electricity from the grid, for example. That kind of investment has worked out pretty well. The whole field of e-vehicles is capital intensive and difficult, but nonetheless, e-vehicles are clearly a coming phenomenon. We're all going to be driving them, within a decade, I think. So that's another fruitful area for investment. So I think all that's positive. And you also asked about how to get into the business. I think it's helpful to have operating experience in a startup before you become a venture capitalist. I mean, it's not essential, but clearly your credibility, if you're going to advise an entrepreneur, is enhanced if you've actually been on the other side of the fence and you've worked at an entrepreneurial startup and you've had a role there. So whether you start your own company or you just join another early stage company, I think cutting your teeth in that way is a very good preparation for then becoming a VC a bit later.
Here's a question from Jeffrey Krasny. In your professional opinion, how important is the R&D tax credit to get innovations and ideas to reduce risk within the startup phases?
So, R&D tax credits, as you know, are not limited to startups. So if you wanted to specifically promote startups, it's not the most sort of finely aimed weapon. Personally, I think the best way to boost the startup ecosystem is for the government to use its money to support basic science at universities, fundamental science. And in supporting fundamental science, of course, you support a lot of PhD students who are getting PhDs in those subjects. And then they become later on either the next generation of academic researchers, or a lot of them will go and work in industry and become either entrepreneurs or work in R&D in industry. And I think that's super important for a strong sort of startup culture. And that's something which the government really has to do, because blue sky fundamental science is never going to be a commercial proposition, and companies simply won't do it. Once you've got that basic science and it's really working well and creating a pipeline of ideas, then I think the private sector can take most of the weight of setting up companies, financing those companies, because it's attractive enough as a business proposition. You just need a lot of government investment in the fundamental science first.
You mentioned spending 5 years on the project, and in reading the book I mentioned earlier, a few things surprised me. Anything that surprised you in the course of your research and writing?
Sure. I mean, I think maybe the most surprising thing was the fact that not only was venture capital super important in getting the Silicon Valley tech world started, but then when I went to look at China, a very different economy, the same was true. So I had read a book by a venture capitalist in China called Kai-Fu Lee, who is a Taiwanese American, got his PhD in the US in early AI specialist, and worked at a few of the West Coast US tech companies. He was at Google, he was at Microsoft. And then he became a technology investor in Beijing. And he wrote this book about how, if you really wanted to understand the rise of technology in China, you had to look at the government's role in supporting the tech. So I read this book and I thought, okay, well, China is a very different economy to the US. maybe that's true. Maybe it's a state capitalist system in which the state really explains the rise of, the big tech companies that we all know, like Alibaba. And it was only when I went to China and I spoke to all those early stage, to all those internet companies that are famous in China, and I understood the story of their origins, so I realized that actually it's not true. That all of these technology companies that became famous, whether it's Baidu or Alibaba or Tencent or Sina or Sohu or NetEase or EachNet or Ctrip, all of them without exception got American investments when they were new ventures. And along with the investments came American lawyers who structured the companies so that you could have American style stock options for the early employees, so you could recruit the talent. And, that is how the ecosystem got off the ground. The government made zero contribution other than to make zero contribution. In other words, the government didn't get in the way, but it didn't actively do anything to promote this. It was actively trying to promote other kinds of stuff in tech, like a semiconductor industry. But we know that even today, China doesn't have much of a semiconductor industry. So the government's attempt there was a failure. What it ignored was it thought, some kind of, consumer internet company that's like doing auctions of stuff or, home delivery of food or, some kind of social media thing. Who cares about that stuff? That's not important, not strategic for us. We don't care. So because they didn't care, the private sector could invest in it, entrepreneurs could start businesses, and then it did super well because the government didn't care about it. So what's stunning to me is that, venture capital, this particular kind of finance, turns out to be crucial for creating a vibrant startup ecosystem, not in one case study, namely Silicon Valley, but in the main challenger to Silicon Valley, which is China. It's the same explanation that holds. And when I look at, newer stories of how, startup ecosystems are growing, whether it's in India, in Southeast Asia, in Latin America, in Europe, I find the same thing again. It's basically, venture capitalists move into the scene and they transform those frustrated engineers who would like to start a company but don't know how to do it. And they liberate those people to start their new companies, just like happened with the Traitorous Eight back in Silicon Valley in the 1950s.
Another question from the audience. This is from Vince Clark. Do you find there are parallels between venture capital in software and venture capital in biotechnology? Do people seem to apply similar thoughts and principles?
That's a great question because it's actually very different. The thing about software is that you don't need to invest very much capital, right? You're not manufacturing something. You don't need plant and equipment. And nor do you need, unlike in biotech, you don't need to go through clinical trials required by the FDA, which are extremely expensive to go through. So all you need to do is sort of write good code and then distribute the code somehow. And the code can go viral if you're lucky, if it's a consumer-facing software. And you get a kind of Facebook result where it goes viral, and in next to no time, you've created this company which is worth more than 100 million, maybe worth more than $1 billion in a matter of 2 years or 3 years. I mean, a stunning rate of value creation. And so you need not very much capital, and you get this very fast result, which makes, if you combine those two factors, into an insanely high internal rate of return. The IRRs are off the charts. And that's why a lot of venture capital gravitated towards software businesses, because the returns were just so attractive. Now, biotech is tougher because of what I said about clinical trials. It's just, you need to assemble these, large groups of patients who are going to be, in a trial. You need to try the new drug or the new medical device on them. You need to have a, placebo double-blind, control group. And that has to be, kind of certified and recognized as being a properly run trial, it's very, very, very expensive to do. It takes a long time. And so the path, A, you need more money, and B, the path to exit is a lot longer. And so biotech can work, it just doesn't work quite as easily as software, and you have to be prepared for that. And so there's a whole different set of assumptions about the return profile that go into biotech. It's obviously a different kind of technology, and the individuals who invest in it, if you're going to be a biotech investor, you probably need to, have some sort of life sciences college training. Whereas in software, you might want to be a software engineer, but you don't need to know biochemistry. And so it is a pretty separate world.
Can I just try and squeeze in one more, Suresh, before you finish, from Bernard O'Rourke? Many national and regional governments around the world are attempting to locally spawn the next Silicon Valley, right? Everywhere they're trying to pop them up now. Is this a fool's errand or not?
It's not a fool's errand if you go about it the right way. And the right way is you kind of set the table for entrepreneurship and venture capital to work, but you don't get too involved in actually doling out money to startups yourself. Now, in Europe, for example, there's been a long-standing error, and by Europe, actually, I include Britain, where the government becomes a major provider of investment funds for startups. And that kind of messes up all the incentives because, you need this sort of power law mentality. You need people who hustle. You need people to go on the board of the startup. It's a sort of, you need high-powered commercial incentives to make this work. And it's not the government's comparative advantage to have that kind of, red meat capitalist sort of profile to make it work. What the government can do and should do is a bunch of different stuff. Invest in basic science, as I said earlier. Make sure there is a stable legal and tax regime whereby you can have venture capital partnerships which kind of are easy to form, and you're allowed to use stock options. In some countries, the tax rules make it impossible to use stock options. So there's some tax stuff. And then importantly, you need to get the rules around transferring technology out of a university into a startup. That licensing process needs to be, low stress, and it needs to be generous to the entrepreneur. So there are some countries where if a government lab or a government financed lab at a university comes up with some idea and somebody wants to take that idea and make a company out of it, it's like pulling teeth. First of all, it takes you a year of bureaucracy to get permission. And secondly, you have to give up, 50% of the startup equity and agree to, pay royalties forevermore. And if that's the case, nobody's going to bother doing it. So, just recently in Britain, Oxford University has finally understood this and changed the terms to make them more generous to entrepreneurs. But other British universities are still to adjust. And that's the kind of stuff, like the setting the table stuff that has to be got right. It's not about throwing government money at startups.
Thank you, Sebastian. Thank you, David. I see that we have completed the 1 hour. I don't know how the 1 hour passed. I'm sure we can stay here another 1 hour and continue to listen to all the extensive knowledge that Sebastian shared with us today. Thanks also to BrandLife team for another great webinar, and many thanks to our audience. So please stay tuned for announcements for the next webinars, and bye for now.